welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest, Ali Pashaei. And before we get started, a quick disclaimer: the Capital Discussion is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that, Ali, welcome back. This is the second time you've been with us on the roundtable, so it's always good to have you back.
Thank you. Good to be here.
You've got the presenter, so you can share your screen now.
Okay. What was that magic key that I would press?
That would be Control-Alt-D, like Delta.
Okay. Okay. All right. Let me know if you see my screen.
Yep, we can see it.
Okay, great. All right. Good to be here. Thanks, Tom, for the introduction. Today, the plan is to talk about weekly SPY strategy that I trade. But before we do that, Tom went through a disclaimer. Basically, I have my standard disclaimer as well that options are risky. You need to be aware of the risks. And also, markets change. Therefore, any results that I may talk about in terms of past performances may not be the results we might get in the future, and consult your financial advisor. My background, real quick, I've been trading for a while, been doing options fairly actively since 2001, and have served as assistant coach to Charles Cottle in the past, and I have, in addition to trading, I do some consulting and mentoring as well. And I trade my own accounts and manage family funds. I have a Google group if you're interested. It's free to join. You can send me an email. I'll add you to my group. Quick background about this specific strategy and how I got to be here today talking about it. Basically, I've been very active with trading the weekly options since 2012 using SPY specifically. And I had early success with it using vertical spreads and diagonal spreads, basically selling short-term options against a put hedge, if you will. And I've been evolving the strategy ever since. It's been an ongoing process, so in my group, what happened was that I shared a recent trade that I closed. I thought people might find it interesting, and that sort of sparked an interest in folks asking me if I can put together a course or a class talking about it, and going into a lot more detail with regards to what I do with this specific strategy. So what I wanted to do is first just give you the quick overview of the trade that I went through with the folks in my group, which basically give you a good background in terms of how this thing started, in terms of the interest in this strategy. So again, standard disclaimer, so this trade, basically, the main core component of this trade is that I sell near the money, near expiration options, specifically puts on the S&P, and I build hedges and other trades around it to enhance the profits and manage the risk. And this particular trade example basically took place a few weeks ago, actually, not long. That was my entry point. That was the time that I closed the trade. When I started it, I think at the time, I started by selling a 208 put on the S&P, and basically what happened over the course of the next couple of weeks, market just went down. And despite market going to around 204 by expiration, I essentially ended up working out pretty good. And I ended up actually taking in more money than what the original credit was because of the adjustments and the scale and approach that I use. Now, this particular trade example is not the easiest type of a trade you could have on a weekly, and it's not the hardest that I've been through. It's somewhere in the middle, but it shows a number of different adjustments I've made during the trade that I thought people might find interesting in terms of how it evolved. One thing that I want to note is that it wasn't until Friday expiration that I thought, this is something interesting that I can share with my group. Let me just do some screenshots. So the risk profiles you're going to see are not as clean. They're basically screenshots that were taken on the day that the trade was about to be closed. Therefore, you're going to see a risk graph that doesn't look as if you're entering the trade. So when I entered this trade, the market was somewhere in this neighborhood. And by the Friday, a couple of weeks later, it was, as I mentioned, down to a 204 level. But at least from the risk profile and the descriptions below it, you should be able to tell how the trade evolved. So basically, I started out with selling a near-the-money put, and I hedged it with a put vertical in this instance to hedge off some of the downside risk. Now, market went lower. And what I ended up doing was selling a put vertical against my hedge vertical, therefore converting it into a butterfly, this is what the butterfly ends up looking like by itself. And when combined with the original put, this is the structure that was resulted after that. Now, my original put, which was at a 208 strike, was in the money, so I decided to roll that down. The fashion in which I rolled it was by purchasing it back and then selling twice as many puts at the 205 strike, but also purchasing twice as many long puts at the 199 strike. Therefore, it's basically buy one, sell two, buy two. And that was the structure that was laid on top of the original trade, hence rolling the short put down, converting it into twice the size as far as a put vertical. And that was done for a debit, that adjustment. And then what happened was that, and this is what the resulting structure looked like after that second adjustment. So the next thing that was happening is that I wanted to essentially add a little bit more protection. So I added a butterfly to the trade, intersecting with one of the short strikes that I had. As a result, ended up rolling down half of the short puts to a 203.5 strike. So by adding a butterfly, it created a roll for me in that situation. So, and then on expiration day, which is where we were, or I was, I then started unwinding the position by basically selling the put vertical that was here at that level at that point, and then starting to unwind the position, and kind of there's a bit of an explanation of down here as to how I did it, why I did it, etc. And then I didn't want to sit through, this was expiration day. If I actually sit through, I didn't have to buy any of this stuff back, but I didn't want to sit behind the computer all day on expiration, so I started buying this stuff back for relatively cheap. But the market did bounce, so in hindsight, it would have been better to leave them alone. So this kind of this is basically that trade, and the end result of it was, as I mentioned, better than the original credit that I would have achieved if the market had actually gone my way. So that was the trade. And then, so what I wanted to do today is go over a little bit of the background behind it. And as I mentioned, it sparked an interest in me putting together a course. So the agenda for today, what I want to do is do an overview and the objective of this trade. It's something that can't be explained. There's a lot of different variations to it in terms of what you do, when you do, so it really can't be fit into a short period of time. And if I do it, it would not be a good thing because it could end up misleading folks. So I really wanted to do a thorough job on this. That's why I decided to do a course on it. I'll talk about an overview and objectives of it, what I try to do with this trade or strategy or approach. The edge behind it, to me, it's very important to understand the edge of any kind of a trading strategy you deploy. Talk about the core structure and topics that I would cover and the pricing and the schedule, and go through a QA. There's a lot of slides and material here. Hopefully, even if you're not interested in the strategy, I think you'll find a lot of useful information here. The strategy overview, the basic structure, as I mentioned, is I start off with some type of a short put structure near the money, and I hedge it. The hedge depends on market conditions, the thinking process that I go through it in terms of picking a hedge. And then I have what I call optional enhancers that I put around the trade to take advantage of if there's a strong uptrend or if there's a downtrend in the market to get additional protection or even make money as the market goes down. There's management steps involved. Now, I want to clarify there's many variations to this strategy. One can use it in a very simple manner where you put a basic structure in place. As the market moves, you pick it up and move it down. All of those variations can do very well, as you'll see, because there's a lot of good edges within the strategy. But so you don't need to get complicated and do a bunch of adjustments to it unless you wanted to. So just wanted to highlight that there's different variations to it. But what I'm doing is adjusting it. In my retirement account, I don't do much of an adjustment. It's a lot simpler process. In my margin account, I do. There's risk management involved in terms of how I define the risk. In cases where I choose to sell naked puts, you have to have good defined risk. You have to define your risk well and know exactly where your exit points are. And position sizing is a big part of this, and the scaling techniques that I use to increase the probability of a success in the results. So this is the basic structure, and that's my management philosophy around it. Now, I'm talking about short puts as a core part of this strategy, but instead of short puts, you can also buy stock and sell call, because essentially short puts and covered calls are the same. Here's just a quick demonstration of that. Is we're looking at basically a short put, a covered call where you're buying 1,000 shares and selling 10 calls, and you see that you have this risk profile. And if you look at the selling the puts, same strike as you're buying selling the calls on a covered call, you see you end up with exact same risk profile. If the Greeks are a bit off, that's usually rounding errors because of the put-call parity and arbitrage potentials. The two structures have to remain the same, so therefore there's really not a huge advantage of trading one versus the other. The reason I bring this up is because some may elect to do the covered call variation with the stock, and others may want to do just the short puts. It will both essentially give you the same results. So what are the advantages of this approach over a basic covered call or a short put strategy? So I really like the idea of covered call or short puts on an index, as I'll explain why. But this strategy takes that concept and attempts to improve it by taking advantage of certain hedge structures and management approaches to get a better downside protection that you would do from a covered call, and also a better upside participation, which is usually the common complaints against a covered call or a short put strategy, where people complain about missing on the upside and having too much risk on the downside. So part of the goal is to address those issues with this specific strategy. The objectives behind the strategy is to collect option premium in a systematic fashion, minimize losses in unfavorable market conditions, and maximize returns in favorable market conditions. And also to adapt to market conditions. It's my belief that you can't apply the same exact strategy or structure to every market condition and expect the same result. So one of my goals is to be adaptive with regards to that. And the expectation is to have long-term positive returns. So what the objective is not is to never lose money. So especially if you start with the bullish variation. As I mentioned, there are different variations I have to this strategy where you could be bullish, neutral, or even leaning a little bearish. But the main objective isn't to never lose money. So my intent isn't to create something that always wins, but it's something that has a positive expectancy over the long term. And when I get into the edge aspects of it, you'll see some of the reasonings behind that. And again, the objective isn't to do exact same thing in every market condition either. So how do I use this strategy? I use it in my retirement accounts. As I mentioned, I use the more simpler variation, the one that would require less maintenance and thought, so I can leave the positions alone and let them do their magic over the long term. I use them for income generation. It's for systematically selling options to generate option income premium. Also use them in an opportunity-driven manner. So when there's a lot of action in the market and there's opportunity to take advantage of that because of the increased volatility, I may come in and deploy a variation of this to take advantage of that, basically be in and then out. So there's really two ways to think about this strategy. One is from a tactical perspective, one is a strategic application. And by a tactical application, I mean you're in cash most of the time and you have specific entry and exit points into the market based on market conditions and volatility. You get in, you make your money, you get out. Or there's a strategic application where your thought process is more longer term. You're in a position most of the time. And for me at least, I adapt to market conditions, adapt the strategy to market conditions. I may increase size or decrease size based on market conditions and volatility. And with this approach, I'm interested in continuously collecting option premium. And the point is that there's no just one way of doing this. You can do it from a tactical perspective or what I call strategic perspective. So is this really a holy grail strategy? And I really want to clarify and say no. Again, just to be clear, my intent isn't to show a strategy which makes money all the time in exact same way. And so why not create that? Again, this is, create a strategy that always makes money. That would be a great thing. If you have the same exact thing that you can do all the time, irrespective of whether it's 2008 or 2009 or 2007, then that would be great. But it is my belief and experience that markets change. We don't know what we don't know. We don't know what the next big crash is going to look like. It may not look like the last two we've seen. I believe that if I try to go back and find a magic adjustment that I could have done in, let's say, the flash crash of 2010, or the magic adjustment back in August of 2015, then I'm doing a bit of curve fitting, which may cause more damage and create a more fragile system than something that is more consistent. So the thinking process is that you're not trying to create a strategy that never loses, but one that, again, has a positive expectancy, loses less and makes more over a period of time. And in my opinion, having the so-called holy grail strategy isn't how trading and investing works, so I don't try that. So what is the edge behind this strategy? So what makes it a good strategy? And I encourage people to, irrespective of whatever trading strategy they're trading, or you've learned from someone else, ask this question: where is the edge coming from? Now, why is it so important to know the edge? In my opinion, when we don't understand what the edge behind the strategy is, we're a lot more likely to abandon it. So as soon as you take a loss or two, you'll give up and move on to the next thing. Trading isn't very natural. It's human nature to stop doing something that doesn't seem to be working and move on to something else. That's only human. But unfortunately, that's not how trading works. So an example of someone who, or ones that understand their edge, are good value investors, for example. They go really deep into understanding what gives a company value. And if the company gets cheap in their perspective, they'll come in and buy it. And they have strong belief that because of their the fundamentals, the company will succeed over the longer term. And they're typically not shaken out. So, and a lot of the good value investors actually do well over the long term. Compare that with me, and because I don't use fundamentals. So if I run a scan that gives me cheap companies because I read this magic scan from a book, and I plug it into the website and it spits out 4 companies for me, and I go buy those 4 companies, what's going to happen is because someone told me it's a great idea, this is how you should invest, etc. The minute those stocks go against me and I'm down money, it's very easy for me to be shaken out of that position because I am following something that somebody else told me is good, and I don't understand the actual edge that the value investor does or the confidence they have in it. So this is why it's important to know your edge. And I guess people may have already heard this metaphor before, is trade like a casino, but it's a very good metaphor because casinos understand their edge. They're not scared because a gambler walks in and sits at a table and walks away with some money. To them, that's just part of the business. That's a small loss to them. What they're trying to achieve is to get as many people gambling as possible, so because they understand they have an edge, and over the long run, they make money. So, and that's a key thing to kind of internalize and understand irrespective of the strategy that you're trading. So the SPY weekly strategy, where is the edge? I'm going to go over these one by one. The first thing is the fact that I'm using an index, and specifically SPY. So why is an index and SPY so great for weeklies? Well, for one thing is there's no company-specific risk. And this is really not an edge, but me being lazy, that I don't need to go and scan for stocks and keep a research on stocks and why they're a good short put or covered call candidate. I get instant diversification, and the S&P is one of the best indexes for that compared to the Russell or NASDAQ. And a lot of the funds are trying to beat this index, and I'm not sure how well they do. I don't think most do that well, given the expenses associated with the funds are taken out as well. The other thing I really like about SPY in general versus just any other index, that it's highly mean reverting. Based on personal experience and tests, I've noticed that it is one of the best mean reverting products out there. It is the best. Which makes it ideal for a short gamma position. So anytime we're looking to build a structure like this around the stock, what you want is if the stock goes down, you want it to snap back up, and if it goes up, you want it to come back down. And therefore, the higher the tendency for mean reversion in the underlying product, the better it becomes for a short gamma or a positive theta strategy. And the other thing about S&P that it has an upward drift to it, which adds a bit of an edge. So what do I mean by an upward drift? Well, what you're looking at is a 2-day price distribution of SPY, and this is based on actual SPY, assuming you bought SPY and sold it 2 days later. So these are based on actual movement in the underlying. This shows data going back to 2001. There's over 3,000 trades in this simulation. It's not up to date. It's about a year old, but it conveys the same message. And what you'll see is somewhat of a bell curve shape that sits around the 0 line, and which we're familiar with. But looking at 2 days out, if you buy the SPY, sell it 2 days later, and you do that over and over again, there's a slight bit of upside edge, and that includes bear markets, 2 bear markets, by the way, 2003 and 5. So there's a bit of a slight edge. It's not huge, and some may call that not that significant from a statistical perspective. But if I switch to a 40-day view, meaning that I buy SPY and sell it 40 days later, you'll see that the number jumps up to about 60%. And that does include, like I mentioned, the 2 bear markets, sideways market, bull markets, everything. So that's pretty significant, which means that if you have staying power within a trade around the SPY, there's a good chance that you'll be in the positive or close in the positive, I should say, 40 days later. And I'll show you some shorter time frames than that in some future slides. Now, here's an interesting thing. Some people may look at this and say, well, this fat tail here scares me. The fact that there were 194 trades, or 6% of them, that actually created a greater than 10% loss for that duration of the 40 days. And, of course, there's some big up moves as well. Now, what if we added a filter where we said that we're only interested in the price distribution when the market was above the 200-day moving average as a proxy for a bull market? If we did that, you get this. So the percentages jumps up by about 5%, over 5% maybe, but the nice thing is that the fat tails start to disappear. So which makes it quite interesting, and just food for thought when you hear the common saying that says, when volatility is really high and market's going nuts, just go out there, start selling puts because they're expensive. And when volatility is low, which is typically what we see when the market is in a bull market or trading above the 200-day, don't sell options because they're too cheap. And this kind of gives you a different perspective of things. Let's just put it that way. So the next edge, so we had SPY and it had an upward drift to it, and it's a diversified index. It's great. How about selling puts? Selling puts, as many of you know, put prices are chronically overpriced in the indexes, and primarily because they're used for hedging purposes. So this gives an interesting edge where majority of the time the realized volatility of the S&P is less than what was implied by the options. So that's why when you go sell a 1 standard deviation put out, you're expecting to your percentage winners end up actually being higher than what the standard deviation implies, is because of this risk premium. And there are really good papers on the SIBO website that kind of compare and contrast the index versus a covered call or a put strategy that kind of demonstrates the edge. What's interesting is that you get really good results by selling premium on the indexes, yet with a even a lot better volatility adjusted returns, meaning with lower volatility than the index itself. So just to demonstrate this, here's looking at the extrinsic value of calls. Here's the extrinsic value of puts, 30 days out versus 10 days out. You'll see that the leg on the left side is raised relative to the leg on the right side. So this is kind of demonstrating that the puts are, not just the puts are more expensive, but the calls, the in-the-money calls have to match, meaning that, and again, if they don't, you end up with the arbitrage situation. So at the end result is it really doesn't matter whether you choose to sell the put or buy the stock and sell the call. As long as you're doing them in the same strike, you should get basically the same results. So we talked about puts, selling puts being a great thing. Why weekly puts? Where is that? Why is that a good thing? Well, there's another paper on CBOE talking about comparing the W put index, which is the S&P index tracking selling weekly puts, versus the put index. And excuse my writing, I'm doing it with the mouse, and I'm left-handed, and I'm using the right hand for the mouse. So it's comparing these two and other against the S&P and everything else. I encourage you to read this paper. It's very good. But the bottom line, the summary of it is that it gives you a very good risk-adjusted return, selling weekly puts, but you also end up collecting a lot more premium on an annualized basis using the weekly put versus the regular put. So, you can kind of see that yourself if you have TOS as a platform. You can take a look at the covered return calculation that they provide and take a look at what they show you for a potential covered return on a option that's 2-day out versus something that's further out, and you'll see what they're talking about there. And that's essentially taking the price of the extrinsic value of the option, dividing it by the underlying and annualizing it, which means that if you could, in theory, every 2 days sell a 90-cent option against SPY, on an annualized basis, you get that amount. Again, the point isn't to kind of say that you're going to do that, but the point is that you get to sell a higher premium on an annualized basis when you use shorter-term options. So the other thing about, interesting thing about the short-term options is the short-term price distribution. And, you want to look at how the prices of the underlying are actually distributed over a week versus a month, and how much does SPY move over a week versus a month. So here's a 5-day distribution, and this is a similar graph to the one we saw before. It's just looking at buying the SPY, selling it 5 days later. I throw in a couple of another additional statistic here for you, is that what percentage of times SPY did not go below a 2% correction for a given week. It's a pretty good number right there, 83% of the time. And there's a bit of an upward drift. But what you're seeing here is that this is the distribution, that the prices stayed within the relatively narrow range, and that's just normal. And when I look at 10 days out, you see a slightly bigger, a wider curve. And if you go out to 30 days, it gets even wider. And you're also dealing with potential fat tails in this scenario. So therefore, when we're talking about selling a put or a call, and here's the zero line, the place that I want this thing to stay is right around here. I mean, that's the optimal location for a market to be if I'm doing this structure. Because if it goes too far down, then I'm taking a loss. And if it goes too far up, I'm not making enough money relative to owning the underlying. So this is the sweet spot for any kind of a short put strategy. And you see that you're better off getting that on a shorter term options. So hedge selection, and this is where the other aspect of where I believe the edge comes from is, and as I mentioned before, the hedging that I do is adaptive, and it's essentially not trying to do the same exact hedge every time, but I take a look at market conditions and volatility, and based on that, pick the hedge. I'm fairly systematic about it. It's not a guessing game as to where the market might go or where volatility might be. It's more about what it is doing now. So it really doesn't require too much of a prediction, more like, where are we right now? And so what I do is I before initiating a trade, I ask myself these basic questions. Are we grinding up? Are we in a nasty bear market? Is volatility low? Has volatility spiked? And I think everybody can very easily provide an answer to these questions without necessarily needing to get deep into any technical indicators. So this is the process that I go through to come up with the appropriate hedge. So position management and position sizing. This is where I believe the other edge or advantage for the strategy that I use is that what I try to do is minimize whipsaw adjustments, which I don't like. And I also think in terms of defense-first approach. So meaning that whenever I put one of these structures in, I'm almost expecting and sometimes wanting the market to go lower, which gives me the opportunity to scale in at a better price at lower prices. So so that basically implies not coming in too big at the beginning, right? So the proper position sizing is very important. Scaling model is important, and having a defensive posture. If you can take care of the downside, the upside will take care of itself. So, and also minimizing the adjustments. So let me just pause real quick. I'm wondering if there are any questions or anything I can answer at this point, or are we good, Tom?
Let me see. Somebody had a question privately to me. Will the course discuss how to determine market structure, or is that left for the student to decide?
I'll get into some of that. I'll provide, once I go through the course outline, let me know if that answers your question. If it doesn't, then I'll try to elaborate on that.
Okay, and that's it for the questions.
All right. So let me just real quick. So one thing I have in here is the entry and management techniques that I use. I work very hard to be aligned with what I call market behavior, meaning that, as I mentioned, market, especially S&P, is a highly mean reverting product, which means that if the market goes down for a couple of days, there's a high likelihood that it will bounce. And if it goes up, there's a high likelihood for it to pull back a bit. So it's kind of important to try to understand these behaviors, whether we're in a sideways market or whether we're in a trending market, going in that fashion, or whether we're, just moving sideways. So that's what I essentially it's a key component for me. So that's kind of important. Entry and exit timing. This is an interesting concept, and what I'm talking about here isn't necessarily having a crystal ball or some type of a awesome timing approach for the market. And I'm talking about there are basic timing approaches you can use to gain an edge over the longer term in terms of the market. So some basic entry and exit techniques that anybody can use, again, doesn't require any kind of magic or crystal ball. And what I mean by that was that I took a example of a bad entry system on S&P. And, this is not up to date, but it demonstrates the process where, this is This is using what I call a bad entry and exiting 10 days later. So we're not trying to demonstrate that you have a good exit, but you have a bad entry. And here's the same system, just modifying the entry slightly, and you get this result. So it's quite a bit of contrast in terms of this versus that. Now, this doesn't mean, again, this is not intended to be a system. This is not intended to be a trading system, more like a demonstration that with a minor modification and having a perspective of a longer term, you could do quite well by just making minor tweaks. And I'll go over these in the class and provide some, in the second class, provide some mechanical systems which could be of assistance. So the course structure and topics, you know, I kind of debated whether I just do one class or session on this and kind of try to cover this. But then I realized that different people have different objectives and needs. So there is no way I can do that within one class. There's people that are coming in with, you know, limited options experience that are really interested in the covered call or the cash secured put aspect of it on the S&P with minimal amount of adjustments. Maybe a commission issue, maybe that they don't have necessarily want to get into the complicated stuff. And then there are people that want to be a lot more active with the strategy. And then there are people that may not feel comfortable with a weekly option expiring in 5 days and might want to look a little bit further out. And the question is, okay, Ali, can we take the same strategy and do it a little bit longer term? So to be fair to everyone, I wanted to create something a little bit more thorough and complete to try to cover as many variations as I can and go through the pros and cons. So the way I structured it was class 1 stands on its own, where it goes through 2 variations, what I call the foundation, and class 2 and 3 go deeper and cover a lot more variations and different market conditions. And the other thing I wanted to do is provide a step-by-step process as to, you know, versus, and also explain the logic behind each step. So instead of saying, okay, go sell this put with, you know, N number of days to expiration, and then if the market does this, goes down to this degree, then you're going to do this adjustment, and if it does that, you do that, and then you'll be done. What I wanted to do is explain the reasoning behind why I would pick that put to sell, why I would pick this particular hedge to put and buy, and the reasoning and the logic behind each one. So kind of people understand what the thinking process is. And also, instead of providing hard rules, as I mentioned, provide some type of a template format where someone may come in and say, well, I am very conservative. You know, how would I apply this? Or I like to be aggressive. I like this. I think I can make a lot of money with it. I want to get aggressive. Or I want to start conservative, and then as I get better, become more aggressive. So, or someone may come in and say, I am really good with market direction. How do I inject my opinion into this whole process? Or someone would say, I don't want to have an opinion. I want to be market neutral all the time. From a pure market neutral perspective, because the position will have, again, the default variation will have a bullish delta, right? So, but we said that there's an edge in that. So, but there's, you know, can I be neutral and trade it? And yes, and by neutral, I don't mean delta neutral. I mean market neutral, as in I don't know where the market's going up or down, but I still want to start with this. So what I wanted to do is, again, provide a template where you can say, well, I'm this type of a trader, and I have no opinion, you know, and I want to start slow, and here's how I would do it. So that's sort of my goal. So class 1 is where I call the foundation. Basically, as I mentioned, it goes through a step-by-step process or guide. Describing when to enter, provide a basic timing model, what to enter, how to manage it, and how to exit. I'll show 2 management variations, primarily on the downside because it's a bullish structure. And I've intentionally kept this class fairly straightforward. This is something that majority of the time, this is what I'm doing on my retirement accounts, and because I just don't have the time to attend to everything. So what I do is have the simpler variations that I use for my retirement account and the more involved variations, if you will, for my margin account where I can be more focused. As I mentioned, I'll provide customization guides, how to customize it to your objective, the logic behind each step. You know, why are we entering? You know, why is it a good day to enter on this day, not that day? Why is, you know, selling this put versus that put preferred? And the risk management guide, I'll talk about how I approach risk management, and the position sizing guide as to how many number of contracts and how to come up with it. The one thing I don't have on this slide is I've had a number of people ask me saying that, you know, from the document that I posted was that, Ali, you know, what you posted looked really neat. You know, this is basically what it looked like. And I see the merit in that, but this risk down here scares me. Or I want to trade this in a cash account where I don't want to, you know, kind of go through the whole margin that I end up spending for this. Well, there, of course, we can always cap off that risk, but what is the right put to buy? Should you buy at this expiration or next expiration? Why not just do this, which is a basic vertical spread? So this is a kind of explanation that I want to go through and hopefully explain some of that during this class as well. That if you are trading a, now I'll get into this, which is your basic vertical spread, more so hopefully in the second class, but at least the first class, if you are interested in having a margin control or a crash protection, how I would structure it. That's the goal for the first class. The second class, the theme is going to be timing and adapting. So what I'll go over is a timing model, a basic timing model you can use with any charting platform. You don't need any kind of specialized indicators that you would need. But again, the intent isn't for it to be a holy grail system, but provide a good guide to be used as a guide for when it's a good time to enter and when it's a good time to exit these trades. And I'll get a little bit deeper into the different scale-in models and techniques that I use, why I use them. By scale-in, I mean, if you're planning to trade 10 lots, or let's just make it simple, 3 lots or 4 lots of a SPY, what do? Do you do 2 now and then 2 later? And so there's so many different ways you can scale in. I'll go over some of that, pros and cons. I'll talk about a couple of hedging variations, how to hedge in a low volatility versus a high volatility. There's a couple of different variations there. And also management techniques in different volatility conditions. So, how I would approach managing the position in a low volatility environment versus a high volatility. So the class builds on the last class, this one, and kind of goes a little deeper into the different variations and also adding in a timing model. Class 3, which is advanced methods, this is where you get into how do I take advantage of strong bull markets, because a short put is limited gains. Sometimes we get this market condition where it's doing this. Is there a way for me to, A, identify it, 2, take advantage of it with this type of a trade? How would I structure it or manage it? How about bearish variations, meaning that we're in a downtrending market, and I'm not referring to trading the inverse funds or reversing the trade to do it with short calls. I'm still referring to starting with the basic structure of a short put, but then turning it into something that's either neutral or learning leaning bearish. Then talk about a bit about advanced hedging, adding hedge layers, or if you have a larger position, how I would hedge it with an SPX position. Legging techniques, the most conservative thing you can do is not leg, but then there is ways that you can be very methodical and systematic about it, whether it's intraday or even multiple days. So I'll get into a little bit of that. That's a very big topic in its own, but I will cover some of that. And then tips on using leverage. What if you want to use this for not a cash secure type of a trading, but not what I would call a low leverage method of trading it, but kind of trade a little bit bigger. Now let me say this: if you are trading it in a cash secured manner or a low leverage manner, it may be deceiving that the returns are not huge, right? Because you're limited to selling a few contracts here and there. But the power of the strategy comes from the systematic application of it over the long term, where you're able to accumulate credit or take in credit or premium a lot more frequently over a duration of the time. So you can think about the compounding effect that you can add into it. So just because it's the fact that you can trade this, if you do choose to trade it on a shorter term, which, like I said, there's an option that you can do it on the longer term as well. But if you do choose to use it in the shorter term, don't be deceived by the low premium, because these low premiums, if you accumulate them, add up. And that goes back to the whole W put strategy that CBOE has that describes this concept of taking in a lot higher credit over the year using these short-term options. So here's I had someone ask me, this question came up a few times as to how fancy can you get with a short put that's hedged? Well, this is an example of a more advanced trade, something I'm in now in one of the accounts, where there's multiple legs at different strikes, and it's and this resembles nothing like a short put, right? So, and my point isn't that this is the strategy. This is just one variation of how I would layer various positions on to end up creating this position. I don't know to how much of a depth I can get into this specific, but by the end of course 3, what my hope is that when I get into these hedge layers and different aspects of it, and if people will get an idea in terms of exactly how I end up building these type of structures over time. So this thing can get as simple as just this, that you could learn how to use a timing model and use risk management to manage over the course of weeks and months. Or it can get a little bit more involved where, okay, now I'm hedging it this way or I'm hedging it that way, et cetera. So there's like I said, there's many different variations that you can take it as simple or as complicated as you want. Prerequisites for Class 1, just option basics, vertical spreads, understanding delta. If you understand butterflies, that's good. If you don't, it's not required. Class 2, basic knowledge of technical analysis tools, understanding what verticals and butterflies and condors are, and time spreads. It involves some of the hedge variations will involve that. And Class 3, it gets a little bit more advanced. There's more layers involved. So it's the solid understanding of the above concepts. We can get into some of the Greeks with this. I don't heavily use the Greeks and Greek ratios and this and that. It's really not needed. But if you start trading something like this, you may be interested in knowing where your Greeks are. And that's basically the point of that. And just the willingness to go really deep into this variations of this strategy and kind of learn things. So real high level, what I'm trying to do with this course is, instead of just explaining some rules, I would my intent is to explain the reasoning and the logic behind them. Instead of providing a 2-page rule guide, I want to be able to provide a template so you can create your own trading plan from it, whether, so it makes sense for you. Instead of teaching one strategy or a trade, I want to be able to convey a concept behind a series of strategies that you can actually come out with 10 different strategies out of this thing if you wanted to, but kind of understanding the logic and the progression from going one to the next. And instead of, kind of showing any kind of a magical adjustments where, you could have made money in the last 2 crashes, again, like I said, my emphasis is to communicate a thinking process and focus on how you approach a strategy to basically minimize losses and create great returns over the long run with this. Who can benefit from this? If you are a covered call trader, cash secured put investor, class 1 would be probably the place you want to be. If you want to diversify your portfolio with a different strategy, saying, hey, I'm doing this butterfly trade here and calendar trade there, I want to learn something that could complement that as part of a portfolio, that would be good. If you enjoy the rapid short-term returns you could get, that some people like that more action, if you will. And if you don't, that's fine. Like I said, you can also apply some of this stuff in the longer term. There'll be differences, but you can. If you want to learn trading concepts versus just one trade, basically the progression and the logic of how one goes about thinking behind strike selection, adjustment selection according to market. And I think what people can do is take some of the concepts and actually assimilate them into their own trading strategies and adjustment techniques, even if at the end you say, you know what, this selling put business isn't for me, but I really like how you did that adjustment or management or the thinking process behind this. So I think there's value for those folks as well. Just real quick, and we're almost to the end, we all start out by learning what a put and call is, and that's how we start. The next thing is we progress and we learn what spreads are, what extrinsic value is, and the Greeks. And at some point we get into what I call our teenage years, where we're learning a few trade strategies. We learn how to follow a trading plan that somebody else created, and we maybe learn to modify or tweak things a bit. But this could be a dangerous phase as teenagers go, meaning that there's still more to learn. And then eventually, those of us who stick with it eventually learn to become independent traders. And by that I mean we get into a point where we have an understanding of how the game works, and we've developed our own trading plans and our own approach, and we know why, meaning that we know what the edge is behind them, so then we can stick with them. And that is my goal, is really to help folks to get from this to that. And of course, some of us eventually get really good at the game, progress to the next level, and of course there's even higher levels than that, but that's completely a different story. There's some that are even beyond me in terms of their capability that I've seen, that when I watch them, it really amazes me what some of the things they can do. One of my role models is Tony Saliba, which was featured on Market Wizards' first book. If you don't know his story of how he traded around the 87 crash, it's not a commonly known story, but if you can get a hold of it, read about it. He's really an amazing guy. So course pricing and schedule. I really struggled with some of this. I feel like I'm providing a ton of information, ton of value, but because I'm not a name brand, I couldn't go out there and just ask for, even with my 15 years plus trading experience and working with some of the best traders, what I would call in the world in the past, being mentored by some of the best, I didn't feel like I could go out there and ask for a ton of money because, again, I'm not a name brand. And I really am trying to get more people involved in learning the trading process. So what I came up with is basically different options for different folks, and just like the strategy itself, because it's has a lot of variations, I try to come up with flexible pricing. So what I came up with is that per class, $140 if you purchase them individually, and as I mentioned, there's 3 classes. For the first one, I'm providing a special pricing discount, $95 for the first class. So if you choose to do the first class just to get a feel for what this whole strategy can do, and then you decide you want the rest of the course, that would be a $250 charge, which would be a $30 saving, bringing the total to $345. So you can try class 1 and then add the other 2 later. Or you may say, okay, I really like to learn everything there is. This is really good. I've had some people tell me they're really interested in the 2 and 3. So to be fair to them, provide additional discount for a total of $315 for the full course. As far as the schedule goes, the plan is June 4th, first class, June 4th, Saturday, 1 p.m. Eastern. Following week, class 2. Following week, class 3. And it will be recorded and available. The PDF, the recording, everything would be made available to you after the class. So that's it as far as the presentation goes. I don't know if there's any questions I can answer, but there were some questions that came in before where I try to reply, and I did try to cover most of these throughout the presentation. I don't necessarily want to repeat all of them. You can read the slides if you like, but I was asked how big do you need to trade this. You can start with 1 SPY contract if you want for the most basic model, but if you want to use any of the scaling techniques or adjustments, you want to have at least 2-3 contracts. So it's not, you don't need to start big with this. I would not recommend that anyways. Can you apply this to other underlying products, meaning can I trade this on individual stocks or other indexes? Or yes, you can, except because of the reasons I explained why SPY is good, you're giving up some of that edge. And there's a fat tail risk in individual stocks that doesn't exist. But if you want to apply this on to Coke or Johnson & Johnson, with some minor tweaks you can, because, those are the stocks you like and you don't mind it going down on a short term. One question I don't think I have in here that was asked is, can I do this with SPX? You can. The only thing with SPX is that if you need to be careful with is the wider bid-ask spreads and the fact that if we end up with a lot of volatility in the market, you may get not such a great fills. And where SPY is super liquid, I personally don't use SPX for the strategy. I use SPY, but I do trade SPX heavily. But the strategies that I'm using on SPX are things which are a lot tighter in terms of risk. Broken wing butterflies and such. And on SPY is basically what I use. So that's it as far as the presentation and the slides. If there's any remaining questions, more than happy to take.
Yeah, we have some questions.
My email is on the slide too. Anybody who wants to email me with questions, that's fine.
Well, first, we did have a question. Are the slides going to be available? So if you could send those to me, I'll attach them to the recording.
I will do that.
And then people can have all the links and everything. Somebody asked if it's suitable for some IRS 1256 things like SPX like you talked about, but also ES. Have you looked at the futures options?
I personally don't trade them, and I can't comment on how great it would be or wouldn't be on that, but I can't see why not. But I just don't trade the ES options, so I can't really tell you what the differences might be. I think the liquidity is there. That's as much as I can say there.
Yeah, if people are interested in that, the futures options do have reduced good margin, but the commissions are a lot steeper.
Correct.
A couple questions about how long have you been doing this strategy? What kind of returns have you been getting? Wins, losses, that kind of stuff. Do you have any performance data or information?
Right. So as I mentioned early on, I started with the weeklies back in 2012, meaning selling them more consistently, and then it evolved into more of a diagonal type of a strategy for me in verticals. And for the past year or so, it has evolved, or it's an evolving thing where this is the latest incarnation of it that I've been trading. As far as performance, I've been very happy with my results. I'm always reluctant to mention specific numbers, only because I don't want to give people the impression that day one you're going to be able to replicate those results. Because in my opinion, and here's the question that came in even before on that, how much money can I make, is that it really depends on your skills as a developer and your psychology. But for me, the first thing I do is define R, which is what my risk is. And on a risk-defined basis, I have been comfortably getting 100% plus return on my risk, if you will. Now, that doesn't happen every year. That's not even my goal. As I mentioned before, and I don't trade this big. This is not a strategy where I want to come in and put a large account on just this. As I mentioned, on a retirement account, my thinking is mostly on a cash secured basis or slight leverage. So on some years I have done better. Of some years I've done a little worse, but I've been pretty much positive every year with this strategy, thankfully. There has been drawdowns. I think a question popped in on my view for a second that says, what's the max loss? What I do is I define risk, and of course, every time there is when there is a sudden drop in the market, that would create a loss, especially if I'm in a bullish structure. If I were able to detect it sooner, meaning that my trading systems were telling me that the market isn't acting well, so I reduced size or got out of it or created a separate structure, it's done well for me. But there's been times where I've been caught in a downdraft with this strategy and I've taken loss. But my losses are typically small because I have a stop loss mechanism in place to get out of the trade, and I'll talk about that during the class. So the other thing interesting thing about the strategy is that when we've had these periods of sudden drops in the market and then eventual recovery, because of my position sizing and scaling, I've reduced size, but I was able to recover nicely from it, versus strategies where I deploy larger amounts of cash, in which case, especially if I have a directional bias, that if the market drops, I'm forced to exit, and then maybe if the market recovers back to where it was a month later, I'm not for that particular trade or strategy. This strategy is down because I reduced size here and didn't participate for that particular strategy on the upside. So one thing I like about this is because of the smaller size, you can maintain exposure to the market and essentially roll the position to further out, down, and therefore have staying power.
A couple of people have asked that they're not available on Saturday, so obviously you said it's recorded, but can they ask you questions after they watch the recordings?
Yeah, so the way it would work is that if you decide to take the course, whether you can attend it live or not, I'll make the recording available, but then you get the same level of service that if you have questions or whatever, you can email me. If the group is big enough, then what I'll do is set up a private Google group where we could use that or some other group somewhere that we could use as a way of asking questions and communicating.
Great. I think that's it for the questions. So, and we're a little over time anyway, but I didn't want to cut it off early. There's still some information flowing. So thanks, Ali. It looks like a great course at a reasonable price. So I keep thinking, even if you're not trading these cash secure puts or cover calls, the techniques that you have that you're talking about for adjusting and cash risk management and all that, could apply to any strategy. So just learning one good tip in a class like this can usually pay for it multiple times. So
yeah,
that's always what I think about. Yeah.
Yeah, in this particular document, because somebody tried to replicate this in their option view software, first when I provided that, so then I noticed it would be helpful to them if I actually provided the trade log for when I got in. And so for this document, I have the entries and exits and when. And what I did was I also put together the table which shows when was the entry, when was the first adjustment, results adjustment, etc. So this should be helpful to get some ideas in terms of what I did, at least for that trade.
A couple more questions came in. What kind of account size do you need to trade this strategy?
If you're trading, so if you want to trade cash secured, then it's the same amount you would need for a single SPY contract. But as I mentioned, we can always go out and buy a cheap put, and that would dramatically reduce the margin on your strategy. And I've been commonly asked about why not just do a regular vertical spread? Why not sell a put and just go 2-3 strikes out of the money and buy a put? Well, this is how I started out with this approach, trading it years ago, thinking, why would anybody in their right mind, knowing that there's a vertical spread, ever want to trade a naked option? And then there's drawbacks to this, and that's specifically how expensive this put is. So there are different ways of structuring this, and I will talk about them, but it's the structure that would tell you what the margin is. This is obviously more expensive on a cash basis, and this is a lot cheaper.
Okay, so we had 2 more questions pop up. How long is each class going to be?
Good question. I have the agenda for what I want to cover for the class. I originally had each class thinking that it would probably be something around hour and a half, hour to hour and a half, but what I would tell you is that I would go as long as it takes to cover the material for that class and answer all the questions. So whether it takes hour and a half, 2 hours, as long as it's a reasonable amount and I'm not passing out, I make sure all the content is covered and all this. I'm not going to put any limit on it. And
last question I see is if someone purchases all 3 together and decides after the first class that it's not really for them, can they get a refund on the remaining 2 classes?
Well, that's why I broke it out to this structure here. Now, so if you want to kind of try things out, you can just go with the first class and then purchase 2 and 3 later.
Seems fair enough. All right. Well, I think that's it for the questions. So thanks very much, Ali. Looks like a very interesting class you've got coming up, and I hope people see the value in it and join you. I think it'll be very educational.
All right. Appreciate it. Thank you, Tom, and I'll send you the slides shortly.
Okay, and I have pasted Ali's email address in the chat if anybody needs it, if they have any other questions before they sign up. All right, so with that, I will end the recording, and everyone have a great day trading, and hopefully see you in the class. Thanks again, Ali.
All right. You're welcome. Thanks, everyone. Appreciate everyone's participation.
Bye.
Bye-bye.